I'm Greer Isaac, President of Prospect Capital Corporation. Prospect is one of the largest and longest running business development companies in the industry. Prospect has $8 billion of capital and a 20-year history. Today, we'll be discussing one of Prospect's most important cornerstone businesses, multifamily real estate. Prospect's portfolio company, National Property REIT Corp, or NPRC, invests in cash flow, stabilized yield, and tenant diversified real estate properties, including a significant focus on multifamily apartment properties. NPRC, over its history, has invested in 110 real estate properties totaling 35.5 million square feet, of which over 90% by value has been multifamily. NPRC typically focuses on value-add properties, where post-closing investments in both individual units as well as common areas enhance such properties and drive rent growth. Given the current economic backdrop with dynamic forces that include inflation, interest rates, and other macro and micro forces, investors are rightly asking themselves, is now a good time to invest in multifamily real estate? So let's seek to answer that by hearing from our own Ted Fowler, Managing Director of NPRC, who will tell us how NPRC is navigating through multifamily challenges and opportunities. So Ted, there's a discussion in the market that multifamily real estate may be under stress in the current environment. Do you agree with such comments, and what's your take on current multifamily conditions?
Thanks, Greer. Yes, there is distress in the multifamily market, primarily in two spots. One, you've already said we shy away from the urban market. That market today is suffering very high rental prices that are subject to volatility and significant new supply. The other problem, and that's the one I really want to dwell on, which is more impactful in our area, is what I would call poor capitalization structures. This is not to say that it's a commentary on the quality of the assets, it's more a quality of the financing decisions that were made to finance them. So let's look at that a little bit in detail. What do I mean? Excess leverage is a problem in all industries. In multifamily, traditional leverage has been in the 70 to 75% level. But in the period of 2020 to 2022, purchasers of multifamily took an interest rate bet. They bet that they could take down 75 to 80% advance rate loans on a short-term floating rate basis and hope that when these loans came due in 3 years or so, they would be able to refinance them. Well, let's look at what happened. Interest rates spiked up 500 basis points from the time they put those loans in place during the period I mentioned. SOFR today is 5.3%, not 25 basis points. They made an interest rate bet. It was not right. It was wrong. So now the loans are all coming due in the 2024-2025 period. There's reportedly $1 trillion of multifamily debt coming due in this period of time. And in order to refinance that debt, which is now maturing, high interest rates preclude rolling those loans over at the same advance rates that's outstanding. So what are they going to do about it? They need equity. And not all owners have equity to infuse and delever the property to a point where it can be refinanced. Today, because of high interest rates and loan value and property values are down 15 to 20%, advance rates today are in the 60 to 70% level. So the amount of equity that's needed to refinance these loans is substantial. I look at this as a distress for the people that have the problem and an opportunity for those that don't. One of the great assets today an owner can have is liquidity. And if you meet a distressed owner who is trying to refinance his property and you have the liquidity, you'll be able to put that money into his property at a valuation that reflects the distress that owner has. That owner, to succeed in rolling his financing, is going to have to capitulate on price, which creates the opportunity. One man's distress is another man's opportunity, I like to say.
Makes sense, Ted. Excessive leverage is indeed a driver of future pain in so many markets. including but not limited to real estate. Ted, another issue being discussed pertains to rent growth. Rent growth slowing after significant multi-year gains. What are your thoughts about rent growth from an NPRC workforce housing standpoint?
Good point. The statistics that you're quoting are widespread, but I don't think they make the correct point. And that I'd like to start by mentioning not all multifamily properties are created equal. Workforce housing, to put a pin in it, is a very distinct asset class within the overall housing world. And I'd like to stress that it is suffering the slings and arrows of rent growth to a lot lesser degree than its alternatives. So what is going on in rent growth? And let's put the properties in two silos: workforce versus more luxury level urban properties. Luxury urban properties today have a much more volatile rent growth scenario. Why? Rents are declining in those markets, actually negative. There's an urban exodus. People who are leaving the city to work from home, a post-COVID event of persistent work from home issues, urban safety issues, urban health issues, urban child education issues are all impacting the decision of where do I want to live. And a lot of people living in New York, Chicago, San Francisco, LA, and other places are voting with their feet and moving to suburbia, which is where we operate, thankfully. The other thing that's impacting the urban market is with these very high rent levels that had persisted through 2022, a very significant volume of new construction was started in the urban high-rise market. And those deliveries today are coming onto the market just at a time when we're in an inflationary period, wage growth is not keeping up, and they're struggling to get those properties rented, which is impacting rents on the existing luxury properties. So in short, the urban market is seeing and is the source of most of the statistics that you're reading about in rent growth. The high cost of new construction today is skewing the market to that tenant making well north of $70,000. Yet our market is the largest demographic of workers in America. So we like to think that the rent growth we're getting today is actually less than it was 18 months ago, but we're still enjoying 2 to 4% rent growth, which is pretty strong relative to those statistics that you just cited, I think.
Very helpful, Ted. Thank you for explaining how the workforce segment of multifamily behaves really quite differently from other apartment sectors and provides an insulation both for new supplies you mentioned, as well as a trade-down benefit when consumers undergo periods of stress.